From New York City for our viewers worldwide, I'm Dani Burger in for Jonathan Ferro. Stability, finally. After 3 days of selling that push equities down 4% for the month, front-end yields touching 5%. We're calm now. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, futures edging higher after 3 days of declines. Sentiment improving as earnings take center stage and yields retreat from their highest level of the year. We begin with the big issue. Chair Powell signaling higher for longer.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's get to Ira Jersey of Bloomberg Intelligence for more. Ira, yields have already been moving higher before Chair Powell spoke. 40 basis points higher for the 10-year in just this month alone. So what changes for bonds, if anything, to have a Chair Powell who's clearly less confident on inflation's trajectory?
Yeah, Jay Powell yesterday was as explicit as he's been, saying that we're not going to be cutting interest rates if inflation remains above our target and the economy remains reasonably robust. And, the market was starting to price that, as you noted. And I suspect that that he'll be even more explicit in the next 2 weeks when we get the next FOMC meeting. And I also suspect them to, there's no summary of economic projections at this meeting, but I think that they'll guide toward the idea that, hey, we're not going to be cutting unless we see significant changes in the economy at this point. And the market's starting to price for that. In fact, the market's pricing almost a 30% chance of a hike later this year. I don't think that that's going to come about, but the chances of them just being on hold the rest of the year are way higher than they were 3 months ago when we were pricing for 6 or 7 rate cuts.
I guess this is the thing, Ira. The market moved before Powell. Powell is almost a lagging indicator at this point if the market is already pricing at a 30% chance of a hike. So if we get the next meeting, as you say, and they are delay, does the bond market have further to move?
Yeah, it could have further to move, and I think the 2-year yields could move up just a little bit more, maybe to about 5.15%, because at some point the market's going to continue to price for the Fed to cut at some point. It's just that they might not start to cut until 2025, and then if they do, maybe it's not that severe, and because of that, the bond market's going to adjust for that. The other thing about the long end of the yield curve is, could you see 5% again? The answer is probably. Particularly if the Federal Reserve is much less dovish than it has been in the recent past. There's still a lot of forecasters who think that we're going to see significant slowdown in the second half of the year, so maybe we'll get a cut come September, November, December. But again, if we're waiting until we cut, then the certainty of that cut goes way down, and that's why the bond market has to adjust for that. And you've seen a lot of it, right? There's no doubt about it that the losses in the bond market have been pretty severe. To rally the long end of the yield curve in particular, you will have to see some form of economic slowdown and weakness that generally will lead to slower price growth, so somewhat lower inflation.
Now, irony of wanting a worse economy, Ira, is it's not lost on anyone for this bond market. In the short term, though, we get the beige book out later today. The bulk of the economic data was last week. Are there any real catalysts at this moment, or is it more of a sideways trade?
Yeah, I think that we're going to find new ranges for a lot of the bond market. Maybe not the 2-year note quite yet. Depends on what the beige book says. Beige book usually doesn't move the bond market very much, but it does inform the discussion that the Federal Reserve is going to have at its next meeting. So we'll be looking for any significant shifts. I suspect that it'll be a mixed bag, with some districts doing pretty well and having modest growth, and then others saying that there are some cracks. There are some areas of the country where job market's not as strong, and then others where it is still pretty robust. So those nuances and the regional differences are always something interesting to look at in the beige book, but tends not to be very market moving, at least on the face of it.
Ira, appreciate your time. Ira Jersey of Bloomberg Intelligence. Let's continue the conversation with Franklin Templeton's Sonal Desai and Nomura's Matt Rowe. Great to see you both this morning. Sonal, as we were just saying with Ira, it is a perhaps long time coming of a repricing this market. Let's be honest, we had a ridiculous amounts of cuts priced into the bond market to start the year. We've phased that out. Even Jay Powell is needing to admit to himself that maybe they're not going to achieve as many cuts as they want. So are we done yet? Or is there still more work to do in this bond market to price out further cuts, maybe even more hikes?
So I think actually the issue of hikes, it's a low probability event. We really need to have a significant reacceleration rather than stickiness, which is what we're seeing right now. We're seeing stickiness at an uncomfortably high level. And therefore, I'm not ruling it out, but it's not my baseline in any way, shape, or form. I think 1 or 2 cuts are still quite reasonable. And I think at this stage, it behooves the Fed to not talk the market back up, because that's one of the biggest problems we've had so far. And yes, Jay Powell yesterday definitely went a long way towards essentially following the market, as you said. I would say that we probably need to see a continuation of that, because it's clear that the Fed doesn't have that good an anchor on inflation yet as it would like to or need to have aggressive rate cuts.
That's a great point, Sonal, because we've seen that before from Powell, haven't we? It's almost this accidental dovishness that slips out and allows the market to rally. Matt, what say you? Is the U.S. bond tantrum over? Have we priced out enough cuts at this point?
Yeah, I think the market is getting used to the idea of a potential higher for longer state. And a lot of the equity markets rally was driven off of a hope that we would revert to more accommodative policy into that, that steady stream of rate cuts, which is now being pushed back at best. I don't think that this story is over by any means. There's a complicating factor of it being an election year. And there are stubborn aspects of inflation, as Sonal mentioned, like insurance costs for real estate, like the cost of crude oil, that have an inflationary impact on the market that is somewhat outside the control of the immediate policy decisions.
Of course, the complication of that in a world where inflation is still higher, plus an election, as you mentioned, Matt, plus geopolitical concerns, is where do you hide out? You certainly can't do it in bonds, as we've been discussing with the tumult there. You can't really do it in the yen, considering the sort of dynamic the BOJ has to play out with. Sonal, does that leave us with just gold?
I'd say that there have been years where I've thought about gold as a good hedge for inflation, but I would have thought that would have made more sense when inflation was really high. Right now, I don't see it that much. I would actually say we take a deep breath. We continue to be relative, clearly there's a lot of cash on the sidelines and it's earning well. I think you go towards ultra short in terms of duration, but be prepared for the fact that the market tends to overreact in every direction. And as we get closer to the end of the year, we probably will see a rate cut or two. And I tend to be less of the view that it can only happen in December or September. You could have it in November. It's a couple of days after the election. The election's done. I think if the Fed focuses on the data, the Fed will cut when it feels that it has the ability to do so. I do think that the actual cutting cycle is going to be far shallower than the market hopes for. So it's not just delayed. I think it's very shallow.
So what needs to change if it is shallow? What's mispriced right now? Is it equities, for example?
Well, probably. I would say right now, equity, maybe, I'm not an equity expert, so I'm not going to stick my neck out too far here, but equities definitely are not pricing in the idea. If equities at this point are pricing in a protracted rate cutting cycle along the lines, taking us back to the type of rates we've observed for most of the post-global financial crisis period, I think that would be a mistake. Because I think that neutral Fed funds is definitely closer to 4 than the 3 to 2.5, 3 that the Fed currently is looking at. And if they're looking at 4, it has a meaningfully different impact in terms of what equities are pricing and where we should see 10-year yields over the medium term.
Matt, let me bring you into this. What do you think of this idea that we're really underprepared at this moment, at least from a risk perspective, that the cutting cycle might be shallower than we're used to?
Yeah, I mean, I would take a more definitive stance on this, that I do think that equity is overvalued, and it's a lot of the hoped for rate cuts are priced into that valuation. So there's a little bit of a tension between those two things, and I think that the whole point of cutting rates to zero is to push investors further out in the risk spectrum. They got comfortable with being long equity risk premia in multiple forms, including selling volatility on indexes and things of that nature. So we should start to see more of a pullback from that risk attitude. When you look at the valuations on equities, you look at the geopolitical situation, we have earnings just kicking off right now, and we have uncertainty where inflation and rates are concerned. And there's an unfolding story in the European high yield market right now that I think is pretty underreported. So I like being long equity volatility strategically and in the right way as a risk mitigation tool, and I like being long credit, newer vintage credit in the right way. You can think about it as a long short volatility trade, right? Like being long credit is a short vol trade where you're being compensated in the form of interest and accretion, but you need to have some sort of ballast to that trade. But I don't like equity. I think it's inflated across the board.
If you don't like equity and valuations need to catch up with fundamentals, how much worse does it get, Matt? What to you would be, all right, that's a fair valuation. How much lower do we need to get?
Well, I mean, you can look at year to date as an interesting barometer for how much of a rally this year was driven by a hope that we would go back to some form of cutting rates. Now it's somewhere between like 8 and 10%, I would say, at the S&P level. Obviously, the Russell 2000 has taken more pain this year and this month in particular. It's down about 6%, if I remember correctly. The Russell 2000 is more credit sensitive. They're more sensitive to cost of capital. They tend to borrow, and when they do borrow, they borrow at higher rates. So the impact of a higher cost of capital is going to be disproportionately negative on those that have a higher cost and those that are more reliant on it. A lot of the present value of anything is equal to the future value if the rate is zero, and then you start taking rates up and you start seeing the discount rate flow through the model, and it doesn't impact everybody equally.
Matt, I got to be honest, in this day and age, it feels like a lot of people have left their Finance 101 textbooks at home. So thank you for reminding us how we discount future cash flow. I think we all need that lesson. You both are going to stick with us, Sonal Desai and Matt Rowe. Okay, let's look at some of the stocks now that are moving ahead of the opening bell. Here's Abigail Doolittle. Hey, Abby.
Hey, Dani. Well, we are looking at the possibility, as you mentioned earlier, of a first up day in 4 days. And a piece of that, United Airlines up 6.5%. They put up a much narrower loss in the first quarter. Their revenue was better. But the real news is the fact that their profit forecast for this current quarter is better than what the street has been estimating, and easing concerns around any possible impact or fallout from Boeing. Take a look at Alcoa, up nearly 3%. The quarter wasn't great, but the stock is higher on reports that President Biden may call for higher tariffs on steel and in aluminum. And then finally, Children's Place, the small cap stock, it is up 25% on the news of a fresh $90 million in funding from a Saudi investor to strengthen their liquidity position. There is a stunning 54% short interest on that stock, Dani. I'm guessing that much of that big move up on Children's Place has everything to do with that short interest, a short squeeze.
Abigail, appreciate it. Abby Doolittle there. Okay, coming up, President Biden makes his pitch to steelworkers.
I think a good deal of what you're going to hear in that regard over the next coming months is, in fact, tied to the election cycle in the United States. Once we get through that, I think that there will be a possibility of the two sides finding their way to a better modus vivendi.
Modus vivendi. You don't hear that enough, do you? The president calling for higher tariffs on Chinese steel and aluminum. That conversation still ahead on Bloomberg.
There are clearly going to be no-go zones in the relationship over everything from Taiwan to South China Sea to military competition itself. But I think the possibility of continuing to have coupled economies and not stagger into a decoupling of these two massive economies, I think I'm cautiously optimistic we can work through that after the election.
The White House is targeting Chinese steel and aluminum. President Biden calling for higher tariffs on certain products as he looks to shore up the U.S. steel sector. Leo Brainard, the National Economic Council director, saying, quote, "We must invest in American manufacturing, but we also have to protect those investments and workers from unfair exports associated with China's industrial overcapacity." Joining us now for more is Bloomberg's Anne-Marie Horder. And Anne-Marie, Biden is going to be in Pittsburgh pitching this. What are we expecting to hear?
Well, that's exactly why you're probably hearing such a policy like this, because he's going to be in Pittsburgh and because he's going to be talking to steel workers. This is, really a pivotal state for this election when it comes to union workers. It's almost like they decided to have an election visit and then decide what the policy is going to be because of how small Chinese imports of steel and aluminum are in the United States, about $1.7 billion worth in 2023. This is a very small market. But of course, you're going to see from now until November a lot of policy levers that the president can really lean on to probably tap into some parts of the electorate that he is trying to shore up. So today we're going to be talking about steel tariffs on Chinese aluminum and steel. Then, getting closer to the election, potentially, Dani, we could see things on like tariffs on China EVs. That's been a big discussion. And really what we've seen, whether it's Secretary of Treasury Janet Yellen in Beijing, or I had a conversation yesterday with the White House's John Podesta, it looks like they're getting ready to pull that next lever.
Anne-Marie, appreciate it. Anne-Marie Horder in there, who's on her way after this to D.C. at the IMF. Safe travels, Anne-Marie. Sonal Desai and Matt Rowe are back with us. Well, look, we already talked about this idea of election risk. But in terms of the actual contours, Sonal, if I can start with you, the contours of different policy, of what might be threatened in terms of tariffs, in terms of taxes, anything that might impact the market. Is it too soon to trade it?
Mainly because the election is really close as far as the polls seem to be. In terms of the 20,000 foot up in the air picture, I really don't think there's much to choose from the perspective of the fiscal deficit, which I think is going to be large in either case. So it's unhelpful from the perspective of issuance. But from the sectoral perspective, there are clear differences in energy policy on the side of a prospective second Biden administration or a prospective second Trump administration. Similarly, on everything to do with renewables, you would likely see differences in these areas as well. And as we get closer and the two teams start talking more, we will get greater insight. One thing which is true, though, on the issue of tariffs, we hear a lot of fear about the talk on tariffs. But honestly, during the first Trump administration, a whole bunch of tariffs got laid on, and none of them have really gone away. So, I don't think there's very much to choose between these two political parties.
Yeah,
They're quite popular.
And things like attitude towards China, which goes hand in hand with the tariffs, all those things.
Absolutely.
Yes, Matt, what say you on this?
Well, I think it's hard in an election year, again, because a lot of things are said when running a campaign that are trying to feel out the audience and sort of find their way toward a policy that's going to resonate with their base. So without taking sides one way or another, I think it warrants caution during an election year to trade, as you mentioned, or position based on discussions about policy, because a lot of things are tested in the discussions and in the debates publicly going into it. We look more towards hard catalyst things like, if you remember back to the Section 301 tariffs that were initiated, there was a hard set of dates that you could quantify, and then you could take action on because you knew that there was an actual policy in place and how things were going to shake out. So I personally, think tariffs are an interesting tool, and they've been used throughout time, and they obviously can have an inflationary impact in the immediate on domestic, the domestic use. But they're a very important tool, and as we're moving towards a more fractured global environment where globalization is kind of going in rewind, I think these things are increasing costs in a lot of places that aren't terribly surprising. We've seen them before. They're likely to continue. So we look at it cautiously, especially in an election year.
And it's yet again, Matt, one of these contributors to inflation that I don't see how the Fed not cutting sooner is going to fix. Things like that,
Right.
Things like immigration. So if we're stuck in this environment, Matt, where that sort of stuff is going to continue to be a pressure on inflation. Are we living with higher inflation for longer?
I think so. I think we're going to be living with slightly higher inflation for longer because a lot of the aspects are outside the control of fiscal and monetary policy, or at least direct control. I also think that this is one of the reasons why I think that volatility is mispriced in the market, because when you look at volatility as an evidence or a barometer for certainty or comfort, there has been a lot of confidence and a lot of comfort, but at the same time, we've seen a very, very high degree of dispersion. So that meaning that, a lot of companies are going up, at the same time, a lot of them are going down. The net effect has been a glide higher in the market. That could very easily tip to the other direction, where you start to see these aspects of the market impact equity in particular.
Well, Matt, so just to change tones here, because Sonal, I'm not going to ask you about the equity story, because I know, as you say, you're not an expert. Although, I'll be honest, you sure sound like one when you talk about equities. In terms of just positioning and what the tipping point might be. I mean, we have seen this really big buildup of people getting more bearish on this Treasury market. Yes, I know that those inflation dynamics are there, but quickly, Sonal, unfortunately only about 30 seconds here, but are the yields tempting at all?
They're beginning to get there, but I'd say that that band is really 575.5. And then I think technicals on the other side will start coming in to make it less attractive. So, yeah.
All right.
Getting closer.
Getting closer. At least we're making progress in some direction. Thank you both very much for joining Sonal Desai and Matt Rowe. Appreciate your time this morning. Coming up, we're going to get you your morning calls, and later, futures rebound after 3 days of declines. Better than expected earnings boost sentiment ahead of the opening bell. That conversation still to come. This is Bloomberg. Time now for your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, TD Cowen upgrading e.l.f. Beauty to buy. They highlight the recent product innovations and effective marketing strategies. Next up, Mizuho initiating coverage of Royal Caribbean with a buy recommendation. They see potential upside to upcoming earnings estimates. Finally, Jefferies downgrading Urban Outfitters to underperform. They point to weakening traffic trends and mounting competition. Meanwhile, it is calm for this equity market. Finally, after 3 days of losses, we're headed down 4% for the month so far. A difficult trading session, but today it gets easier as we expand in terms of earnings. The banking stocks, the big banks are done. We go to the smaller banks next. We're going to break down all the stocks moving on earnings this morning. That conversation coming up on Bloomberg. It's the countdown to the open. I'm Dani Burger in for Jonathan Farrow. Just moments away to the start of trading, and we're on better footing this morning than we have been all this week. S&P futures up nearly 0.5%. NASDAQ not doing as well, but just a little bit up, 0.4%. Finally, a breather. 3 days of brutal selling based off of higher yields. Front end goes to 5% off the back of hawkish speak, and that pricing out of rate cuts. The things that did the worst are doing the best this morning. Russell 2000 up 0.7%. We're also getting a breather in this bond market. The selling turns to buying. Maybe finally some temptations with yields above 4.6%. Yields moving lower by 5 bips. Euro also finally strengthening versus the dollar, up 0.25%. Dollar has been dominating, especially when it comes to Asian currencies. Again, a little bit of respite today, as has the March higher in crude. Geopolitical concerns, they are real, but at least on the back burner for today, down 1.33%. NYMEX crude at $84 a barrel. When it comes to individual stocks, one to watch at the open is Tesla. The automaker is asking shareholders to hold a second vote approving Elon Musk's $56 billion pay package. Bloomberg's Ed Ludlow has more. Hey, Ed.
Good morning, Dani. Tesla is down modestly, a few tenths of a percent, but down all the same, meaning it is declining for a fourth straight day, its longest run of declines since January. We've been waiting for this proxy, and you're right. The two main headlines are, one, that Tesla's board wants investors to go back and vote on that very same 2018 pay package, the same package that the court shot down after an investor complaint. In the proxy itself, Robin Denholm, who is the chair of Tesla's board, criticized the Delaware Chancery Court's decision back in January and actually called out the judge, Kathleen St. Jude McCormick. She accuses the court of second-guessing the investor's decision to approve that package in the first place. So it's an interesting dynamic. Tesla now flat, completely flat, but we'll see where we go over the course of the day. The other decision that the proxy puts to investors is to vote on reincorporating Tesla in the state of Texas from Delaware. We knew that this was something that was on the table, but the devil's in the detail. And what Tesla says in its proxy is that they had set up a committee led by one board member and advisors to have this process in parallel with Musk's pay package so that no one could accuse Tesla of using the issue of moving or incorporating to Texas as leverage in a pay package dispute. And the final piece of context, which I think is important, the stock bouncing around down 0.4%, is remember, Musk has said that if he doesn't have voting control, he will go and work on artificial intelligence elsewhere. And his reasoning is not one of financial gain or wanting to upset investors, simply that he doesn't think he can take the actions needed to do the AI progress he sees as necessary without that voting power. And now we're seeing those actions play out. For what it's worth, behind the scenes, I'm hearing from sources that it's layoffs continue, but the AI and autopilot and FSC teams are pretty much untouched. And that gives you a good sense of where the priorities for this company are right now.
Interesting. Ed, appreciate it. Bloomberg's Ed Ludlow. Let's now turn to the retail sector. The FTC is preparing to block a lawsuit, preparing a lawsuit to block Tapestry's $8.5 billion planned takeover of Capri Holdings. This, according to a person with knowledge of the matter. Tapestry had no immediate comment on the expected suit. Bloomberg's Abigail Doolittle has more. Abby.
This is super interesting, Dani, because the fashion industry is typically not the target of antitrust action. But more recently, the FTC has appeared to be trying to develop the law and new theories of harm from M&A, whereas the DOJ has been going after cases that seem more winnable. Now, this possible lawsuit has been circulating for at least a week in terms of its possibility. And what people are saying it's based on is the fact that in paperwork for these two companies, and of course, Tapestry sells leather goods and other luxury goods under Coach, Kate Spade, and Stuart Weitzman, while Capri controls high-end labels Michael Kors, Versace, and Jimmy Choo. So the concern would be that this luxury conglomerate would be too big. But the point that the FTC may be working off of is paperwork that they say that in outlet malls that they're pricing that they're each other's main competitors. On the other hand, that is such a small subsector of the overall market that there are some people saying that their case may not win suit. That said, at a recent ABA conference, some sources are saying that lawyers there think that the antitrust lawsuit here, the potential for it, that the FTC may have a good chance of winning. Stay tuned. I'm sure that this one's going to be in the news, Dani.
Okay, and we're happy to have you back to cover all of that development. Abby, thanks so much. Let's turn now to aluminum. Shares of Alcoa moving higher. President Biden is preparing to propose higher tariffs on Chinese steel and aluminum during a visit to Pittsburgh. Katie Greifeld has more. Katie.
Yeah, Alcoa shares currently on the rise after that report. Bloomberg News reporting, of course, that Biden will propose new 25% tariffs on certain Chinese steel and aluminum products as part of that ongoing review. Biden is calling for raising Section 301 tariffs on a wide range of Chinese steel and aluminum, namely those products that currently have 0% or 7.5% tariffs should each be raised to 25%. Now, we're talking about a relatively small segment of the U.S. market here. Imports of Chinese steel and aluminum totaled roughly $1.7 billion last year, but officials said that these tariffs, they're designed to head off an anticipated surge and to safeguard the U.S. market. You can see Alcoa shares currently up about 2.4%. Now, Biden, he's also expected to reiterate that U.S. Steel, which is based in Pittsburgh, should remain American-owned. Now, remember, However, of course, Japanese company Nippon Steel wants to buy U.S. Steel for about $14.1 billion. And the United Steelworkers Union, which Biden will speak to on this trip, has opposed that acquisition. You turn to shares right now of U.S. Steel and Cleveland-Cliffs. Shares are higher at the moment, Dani.
Katie, thank you very much. All right, let's now turn to airlines. United is forecasted better than expected profit this quarter, easing concerns over the fallout from Boeing. Isabel Lee has more. Hey, Isabel.
Hey, Dani, investors are definitely liking what they're seeing. Shares are popping to 8.8%. That's the highest intraday gain since January 2023 this year. And to your point, it's really the better than forecast earnings we've gotten. And this really allays concerns that the Boeing aircraft delays and the regulatory pressures are not going to derail, or at least risk derailing, any of their expansion plans. We have adjusted earnings for the next quarter also looking rosy. They're around 3.75 cents to $4.25. That's higher than the $3.73 estimates. We have Cohen analysts saying that they were encouraged by the results, and we have Seaport saying that the print handily bettered consensus estimates. So the outlook really shows just how challenging the beginning of the year was for United Airlines and for the industry more broadly. We were marked by a series of safety incidents. We had a lot of grounding of some planes and the late delivery of aircraft. But for now, shares are up around 8% year to date, but this is already including the Federal Aviation Administration review. So that has already stunted near-term growth because United Airlines had to really delay the start of 2 new routes. But today it's a good day. Now shares are up around 9%, Dani.
Maybe a good day for United Air, but maybe not for Boeing as they head to Senate hearings. Isabel, thank you so much. Turning to this broader equity market, Bank of America is out with its latest fund manager survey, writing that, quote, it's the most bullish survey since January of 2022, the biggest jump in global growth optimism since May 2020, a record jump in allocation to commodities. Risk assets tactically are much more vulnerable to bad news than good. Joining me now is Gina Martin-Adams of Bloomberg Intelligence. Gina, so great to see you this morning.
Thank you.
Okay, so I know this is a little bit awkward to talk about this after a sell-off, about everyone being so optimistic, but is there a degree where positioning looks overly stretched now?
Yeah, well, we did end the first quarter with positioning somewhat overly stretched, and we see that most evidenced through correlations. Correlations on the S&P 500 as well as on the global indices reached the lowest levels that we'd seen since 2019. They're more than a standard deviation below long-term averages. Usually when you see pairwise correlations in the market at such low levels, it does indicate a degree of bullishness. When we look at our broader sentiment indicators from the market itself, though, and again, we're not analyzing what people say, but really what they do, the market itself looked somewhat closer to neutral. So I do think that a lot of it is concentrated in the biggest of the big caps globally as opposed to small caps in all equities. And that's an important clarification to make in terms of where bullishness really is in the most defensive components of the equity market still, which is interesting because normally if you see overly bullish sentiment, it would be in small caps. It would be in EM. Everybody would be all in. That's definitely not the case just yet, according to our work.
So if more of the all-in aspect is coming from big tech, what happens when we get their earnings? It's due next week. They're projected to lead profit growth in the S&P 500. How much is riding on that?
A lot. Unfortunately, a good deal is riding on it. We are already seeing, though, rotation in the equity market. We follow 30 different themes in our thematic universes work in Bloomberg Intelligence. Of those themes, AI has actually fallen to 5th on year to date in terms of performance. So you've already started to see over the course of the last several weeks, some of the AI themes lose a little bit of momentum. Tech certainly has been showing some topping patterns, reached a magic valuation level. Big cap tech tends to top at about 28 times earnings. We reached that again. And the sector shows a little bit of topping activity, at least in the short run. So some of that sort of steam, if you will, already has been released from the tech sector. That doesn't mean there's not still a lot of pressure on earnings. This is a group that is expected to definitely post the strongest earnings growth among the S&P 500 companies. In particular, the top stocks in the S&P are still expected to lead the rest. Though I will say that is not the embedded expectation going forward. This is supposed to be basically peak growth. So there is pressure on the rest of the index as well, not necessarily to perform in the fourth quarter report, but to guide us to say things are going to get better for the rest of the year. So the pressure's on for all companies to generally put up some decent numbers for Q1 and really guide us to expect better times ahead.
Well, the most recent sell-off feels like the underpinnings is more of higher yields than earnings. But this next leg of higher yields, is it really the type that can do damage to equities if it is predicated on a strong U.S. economy.
Yeah.
And that's why yields are going higher.
I think that's a really, really important point to make, is if what we're seeing is yields are selling off because growth conditions are improving, and that means the demand outlook is improving, that's not necessarily embedded in expectations right now. When we look at the earnings growth numbers, really what analysts are anticipating is much better margin growth from companies. So they're anticipating a slowdown in inflation pressures. They're anticipating some margin improvement to emerge throughout the rest of this year. Top line growth is not anticipated to improve. There's very, very grim expectations, in fact, I think perpetuated by macro forecasts on the earnings outlook. So if we're getting growth beats, and that's resulting in higher for longer interest rates, that actually could be quite a good thing for equities.
Right. There are still consumers. They're still spending. They're helping corporates have profits. What about the argument, though, that says, well, higher yields mean my equity risk premium shrinks, and they're less attractive to bonds?
So the equity risk premium already has shrunk. The equity risk premium is at its lowest level in 20 years. I think the equity risk premium is a bit overstated for its tactical benefits. It's more of a secular story and a long-term story, but the equity risk premium was negative throughout most of the 80s and 90s. You're talking 2 decades of negative equity risk premium. So there's not a lot to say about the risk premium being low. It's just lower than it has been in the last 20 years, and I think that reflects a big inflation regime shift. Most of the last 20 years, stocks and bond yields were positively correlated because inflation was viewed as a generally good thing and reflective of demand conditions. Now we're in a different inflation regime. Inflation could be viewed as supply constraints emerging, creating some margin pressures for the S&P 500. The results of that is you need to pay attention to the equity risk premium, but it's not necessarily your guiding light with respect to allocation.
What about the attractiveness of cash? Because there was a narrative that there was so much in cash that's going to flow out, that's going to go into risk assets. Presumably, if we are higher for longer, that story is getting delayed.
Yeah. So generally what you find in an allocation is equity is not a substitute for cash. Cash is not a substitute for equity. So that's an important thing to consider. That said, certainly there are other alternatives to equities, which is a very different landscape than we've been in since the great financial crisis. Low interest rates have forced investors to add to equity exposure in order to seek some form of return, even in some cases, some yield.
Right.
Now we have other opportunities, other options, and in a diversified portfolio, equities aren't necessarily your best option for in a lot of instances. That said, you buy equities for growth, you buy cash for yield.
And I was going to say, I guess the irony of me asking that question as I was saying it, I kind of realized that's also a good thing for companies who have all of this cash in their balance sheet that are putting it to work.
Yes, I think this is one of the underappreciated aspects of Q1, and this is something we've talked about a lot, is throughout this earnings season, something we're definitely looking for is a potential sign of a recovery in capital deployment, in particular buybacks. Buybacks were very constrained in 2022 and 2023 as the companies really suffered with contracting cash flow. Now that cash flow has started to recover, we're anticipating at least some degree of improvement in buybacks and improvement in capital deployment strategies in general. We're looking for signs of CapEx. So we should start to see that momentum improve for capital deployment over the course of Q1 earnings announcements.
Right. Gina, afraid that's all we have time for. Always a pleasure to speak with you. Gina Martin-Adams there of Bloomberg Intelligence. Coming up, Boeing under fire on Capitol Hill.
You have had this management overhaul in place and the board changing as well. I do think it is a little bit of either. There was the NTSB with the Senate yesterday. We didn't learn anything really new.
Boeing's safety record in the spotlight. That conversation up next. This is Bloomberg.
You have had this management overhaul in place and the board changing as well. I do think it is a little bit of either. There was the NTSB with the Senate yesterday. We didn't learn anything really new out of it, whether what happened on the Alaska flight or Boeing's safety culture. So I'll wait to see what happens today. But given that there's no Boeing executives, I don't think we'll hear much new.
Boeing's safety and culture in focus on Capitol Hill. 2 congressional hearings taking place today. Lawmakers are set to question the safety experts and a whistleblower. The Senate Permanent Subcommittee on Investigations chair saying, quote, the public has a right to know how a once preeminent company with tremendous credibility has really seen its reputation shredded. I think we can guess how that reputation was shredded. Joining us now is Bloomberg's Sid Phillips. Sid, as if it wasn't just one Senate hearing that Boeing had to contest with, it is 2 separate ones. Of course, Boeing officials won't be present there. So what are we likely to hear?
Morning, Danny. So there's two separate sessions. The first is going to examine the safety culture at Boeing, and that sort of promises to be a sort of retrospective about the various practices that experts in a report that was published last month by the FAA are sort of recounting the issues that Boeing has and the challenges it's had in terms of safety. And that was sort of that report predates the blowout of the door plug on January 5th. So that's going to be an interesting hearing. And then an hour later, we're going to hear from a whistleblower who says that the 787 is unsafe. And he sort of pointed out that structural issues with the 787 make the plane unsafe. And that's really going to be an interesting testimony as well, because the whistleblower hasn't really made clear what his sort of basis is, other than the fact that he worked as a quality engineer at Boeing. And we're hoping to see if we can sort of see any more than that. Boeing's pushed back against the whistleblower claims. They've said that the issues that he's raised have been addressed in the prolonged groundings that they had for the aircraft in the start of this decade. So it's going to be really interesting to see how Boeing sort of responds to those allegations, both on the safety culture as well as on the whistleblower.
Has Boeing said anything about these hearings yet? Because as I said they're not going to be there.
Yeah, Boeing's not going to be at the event, so we haven't really heard much from them specifically about the hearings. I mean, they have disputed the account of the whistleblower, saying that they've done various tests to make sure that the planes are safe. But at the same time, we haven't really seen much more from them. So expect more from Boeing, even though they're not going to be on Capitol Hill this morning.
But, okay, if they're not going to be there, we're hearing from whistleblowers. We kind of know what we do know what they're going to say. You just laid that out for us, Sid. Does this change anything for Boeing, having these twin Senate hearings?
It just adds the pressure onto Boeing. I mean, Boeing, as you mentioned previously, Boeing is in the midst of a massive change. The CEO, Dave Calhoun, has said he's going to step down at the end of the year. The chairman has already stepped down, and they've replaced the head of the Boeing commercial airplane division. So they're in a bit of a flux at the moment. This is a really important time for them. They've sort of promised to get things right and fix their issues that have been structural in terms of quality and safety of aircraft. And so this is just going to add more pressure onto Boeing at a time when they're already under tremendous pressure from regulators, airlines, and the general public.
Sid, appreciate it. Sid Phillip there. Now, let's get some of the sector price action this morning and head on over to Bloomberg's Abigail Doolittle. Hi, Abby.
Hi, Danny. So for the first time in 4 days, we are looking at the possibility of an up day. That said, we've had a couple of reversals from early gains, so let's see whether these gains do hold. Right now, sector-wise, we have 10 of the 11 sectors higher, led by materials up about 0.9%. Utilities up about that much, some relief as yields are down for those dividends. Real estate, interestingly, is still down, even with that relief. Let's check in on the S&P 500 apparel index, because we were talking earlier about the possibility of that antitrust litigation suit to be brought by the FTC against Tapestry and the Capri deal. Even so, over the last 2 days, this sector up 1.7%. Most members of this index today are higher, including Tapestry. On the other hand, Capri is down, not surprisingly, if folks think that there's a possibility that deal might not go through. But again, the bulls are out this morning overall. Something to cheer, Danny.
All right, Abby, thank you very much. Speaking of the bulls, airline stocks are also higher after United earnings that we've been talking about today. It is the biggest jump since January. Okay, coming up, we're going to look at some of the market moving events you need to be watching. That's all next in our trading diary. This is Bloomberg. Stocks higher after 3 days of losses. The things that did the worst over those 3 days are doing the best. Case in point, Russell 2000 outperforms up 0.7%. The regional bank earnings are on deck, so can that hold? NASDAQ up just 0.1%, so that's a little change this morning, while S&P up 0.4%. Let's get you your trading diary now, what you need to be watching through this week. The Fed will be publishing its beige book today at 2 p.m. Eastern. Boeing hearings, those happen on Capitol Hill throughout the day. It is a twin hearing. They'll hear from both a whistleblower and an expert panel. Plus, we will be getting more Fed speak, this time from Mester and Bowman. Yesterday, it was Powell and Jefferson that helped spike yields on the front end up towards 5% and backing down. And then on Thursday, we're going to get earnings from Netflix. They really kick off the big tech earnings. Don't forget that this market, the profit growth for earnings, is really predicated on big tech doing well. We're just speaking with Gina Martin-Adams, how the leadership has rotated, but still tech is crucially important. Again, tech underperforming this morning, up just 0.1% here in just 30 minutes of trading. It is small caps that are leading the way. Yields are also calming down after heading to highs of the years. So is the repricing over, or is this just a pause? This was the countdown to the open. This is Bloomberg.